Good afternoon, everyone. I'd like to welcome you to the Halftime Talk feature interview series. I'm delighted to be joined today by James Reeve, Group Chief Economist at Jadwa Investment in Saudi Arabia. James, thanks so much for joining us today.
Pleasure to be here.
Great to have you. Well, it's great to have you also at the top of the year, if you like, for an outlook for the year ahead for Saudi and possibly beyond that. Let's start with your sort of opinion on the outlook for the Saudi economy as it enters 2024. Of course, one key part of Saudi policy last year was its involvement and leading the OPEC plus sort of agenda on oil policy, but we'll talk a bit about that. Give us your outlook for economic growth for the sector, for the country, I should say, and where you see that going.
Sure, I think it's pretty robust, actually. We have penciled in growth for 5.2% in terms of non-oil GDP. And I think it's important to kind of split out the oil sector from the non-oil sector in Saudi. People get hung up on the overall GDP number, but frankly, it's the non-oil economy that counts. That's where all the action is at the moment. We have a booming project sector. I think there's going to be something like 71 billion projects in $71 billion worth of projects in execution this year. And we also have a very vibrant consumption sector with more and more women entering the workforce, setting up homes and getting jobs and, spending money. So overall, I would say that the key sectors are tourism, which is booming, particularly around religious pilgrims, who are now able to stay longer in Kingdom than before and spend more money. And also around, I would say, retail and wholesale, because as I say, shops and hospitality are really having a great time of it at the moment. And of course, the project sector is also capturing a lot of attention, these giga projects, and they are plowing ahead. But there are some signs of bottlenecks and higher costs associated with these projects, because there are so many of them being rolled out that wages are having to adjust upwards in order to attract labor, and materials costs such as rebar and copper and stuff like that is also pushing up project costs as well. But overall, this is kind of inevitable when you have such a strong growth story in an emerging market. Project cost overruns are just part of life, really.
Okay, well, I mean, you mentioned that the non-oil sector, a lot of growth, tourism, etc., retail, mega projects as well. Those mega projects in particular are obviously costing a lot of money. And you're talking about costs, inflation, supply chain. I mean, the non-oil sector has got some great growth prospects ahead of it, but it does need to be funded, doesn't it, by the revenues essentially from the oil sector. And we'll talk a bit about more oil later. But in terms of funding, financing, on that front for these big projects and for the other sectors that you mentioned, where does Saudi stand on that, given those increased costs that you just mentioned?
Yeah, that's a good question. I mean, I think we should probably take a step back and think about the overall deposit base of the banking sector in Saudi, which at $650 billion sounds quite a lot. It's about 60% of GDP, which is about middle of the pack for emerging markets. OECD countries, advanced economies, it's more like 120%. But for an emerging market, 60% is around the average. But about a quarter of that deposit base is actually government money. So there's a danger of sort of double counting when we think about how much capital there is for investment. And even if you take $650 billion as the basis, is that really enough to finance everything that's on the table? I don't think so. I mean, 650 billion will not give you everything that's it won't even give you half of what's on the Vision 2030 agenda, which is obviously the big transformation program in Saudi. So we have to think about other ways of boosting capital. Unfortunately, FDI, foreign direct investment, hasn't yet really gained traction. It's coming in at around sort of $2 or $3 billion a quarter dollars. Not really enough. And then
well, I mean,
equity.
James, sorry, let me ask you why you think that is. Why do you think that is the case?
Well, I think that there is still a reasonable amount of skepticism around the Saudi growth story among foreign investors. I think they look at Saudi as a bit frenetic in terms of the project rollout. The regulatory landscape is often a little bit difficult, quite difficult to navigate, and there tends to be a bit of hyperactivity around regulations and laws, and often there isn't so much follow through in terms of the details. There's also, I would say, a slightly unhelpful tax environment, which all in all, given also the sort of geopolitical tensions that we were well familiar with, leaves a lot of foreign investors thinking, well, you know what, actually maybe I'll head to India or even Dubai. So there is that. I think what needs to happen is the Saudis need to get a project up and running, you know, and show the world, if you like, that it can deliver rather than just deliver, you know, fancy videos. And I think the Red Sea tourist development is probably the best case for that. So I think once that's up and running and it's beginning to be rolled out now, I think then the Saudis can say, look, we can deliver these projects, and you know, you're welcome to take equity capital. So I think, you know, build it and they will come would be my short answer. But for the moment, FDI hasn't really gained traction. And equity capital into the stock market has not really, portfolio capital, I should say, is not really delivering either, because although the Tadawul, the stock market, has a very large market cap, the largest in the region, its liquidity isn't actually that good. And if there's one thing foreign investors want, is liquidity, because they want to be able to get their money out as well as in. So all in all, I think it leaves debt as the most promising avenue for delivering Vision 2030. And I have no problem with that, because lots of countries, Japan, South Korea, China, they've used debt to good effect in order to get their industrialization moving.
And I mean, you don't think that these 5% interest rates that we have today are impacting that thinking around debt?
Well, at the moment, I think it is impacting. The Saudis have been opportunistically paying down longer-term debt, issuing new debt, but I think you're right. It's kind of held them back in terms of really, you know, issuing big numbers. I think, you know, our view is that the Fed will start to cut, and quite sharply, in the second half of this year. And once that happens, I think the Saudis will come to market. And you'll see quite a lot of debt issuance in both dollars, euros, and potentially yen as well.
Okay, and you mentioned, James, there about the mega projects again. You mentioned the word geopolitics, and of course, we are aware that there are certain tensions, particularly in the Red Sea area, as we speak. But I mean, a lot of people also saying they don't think it's going to escalate. Oh, who knows what's going to happen? But just from a sentiment point of view, given that you know, one of Saudi's biggest mega projects is in that zone, given that the conversations that have been had in the last 12 months about a new economic corridor towards that area from Saudi and on through the Levant, any sentiment in the kingdom of hesitancy around the speed at which those ambitions might move forward?
I don't think so. I mean, clearly it's not good to have this sort of activity in the Red Sea. No one's pretending it's a sort of minor irritation. It's a serious problem for trade, and that could actually is already impacting the cost of certain materials that the Saudis need. But I think, frankly, in terms of Saudi investors, they're used to this sort of stuff. You know, it wasn't that long ago that Aramco's facilities were attacked, and the fallout from that was pretty short-lived. And I don't see the Houthi the escalation that we've seen with Houthis, and now the attack on Iraq just today. I honestly don't think it's going to be that long-lived. I think the Iranians will rein in, and there will be some sort of accord or some sort of agreement with the Western powers to keep this to dampen this down. But of course, yes, the mood music isn't good, and again, for foreign investors, it's like, well, why would I invest
Yeah.
in this part of the world when I could go to South Asia or even South America? So yeah, it doesn't help, but I certainly don't think it sort of derails these projects, which are long term and have been through quite a lot of turbulence already.
Okay, James, let's just talk a bit about oil, because yes, the non-oil sector is making headway a lot in Saudi, a lot of new growth areas there. But of course, the primary revenue still comes from the oil sector, and that has dropped this year. Oil prices, you could argue, have been up and down, but of course, Saudi's taken the brunt of some cuts in its volumes that it's exporting to support the price. So it's a fine balance there, but for us who follow the oil markets, we did sense towards the end of last year that the patience is running out a bit by Saudi in terms of how much longer perhaps it can carry the mantle to support that price, and particularly like as it affects budgets and deficits going forward. So, what do you expect for the year ahead, and do you think Saudi can afford to continue to sort of take the brunt of those cuts? And many people are saying they're going to have to stay in place for a while.
Yeah, you're right. I think they will need to stay in place for a while. We have a working assumption that they will be extended until the second half of this year. And then we think that as the Fed begins to cut interest rates, risk assets such as commodities will get a lift, and that will give the Saudis cover, if you like, to start unwinding these cuts very, gently and in a measured way. But I think there is actually downside risk that they might need to be extended further than the halfway point of this year. I think there are two sort of countervailing forces here. One is that the budget position has actually been boosted quite a lot by the fact that the Aramco are now paying the so-called performance-related dividends to the central government, and these are based on Aramco's free cash flow. And Aramco's free cash flow is, as you can imagine, pretty massive and is not directly linked to the oil price per se. So that gives an extra bit of, well, quite a large bit of cash to the central government budget. We think that the budget will actually be in surplus next year, albeit very small, based on these additional payments. Also, bear in mind that we have the PIF, the Public Investment Fund, and the National Development Fund, who have their own balance sheets and are deploying them in Kingdom. Now, I'm not saying that they are somehow autonomous from oil prices, because they're not. However, if you think about the PIF's balance sheet, it has investments all over the world. So it is, in some senses, not delinked, but it's got a much softer link to oil prices than the central government. And it's the PIF, particularly, which is delivering these so-called giga projects. So I think the link between the budget, the central government budget, and economic activity in the kingdom has been, I wouldn't say broken, but it's certainly much softer than it used to be. Back in 2015, yes, if oil prices fell, capex would be slashed, etc. But these days, the PIF and the NDF, to a lesser extent, can continue the spending. All that said, there is no doubt that the kingdom wants to keep oil prices as high as possible. The Minister of Energy has quite a lot of autonomy, and he's quite, I would say, fixated on keeping oil prices higher. And I think he's willing to take the hit of losing market share to other players, Russia in particular, if it means keeping prices high. And I do think also that were prices to drift down to, say, 70s, early 70s for an extended period of time, then I think the central government would probably start cutting expenditure on capex. So yeah, the two forces are in play. They want higher oil prices for sure, but higher oil prices are not as critical as they once were to economic activity in the kingdom.
Okay, that's interesting. And you mentioned the PIF, James. I mean, with the outlook for sort of the global economy, for sort of how companies may be doing in the US and Asia, et cetera, for sort of, so in terms of sort of investment outlook for the PIF, would you say be looking at this year going forward with the economic situation in the world looking a bit more negative? Would there be good bargains out there? Is that something that the PIF would be thinking, do you think, as it moves forward this year?
I think they'll be looking opportunistically around the globe, no doubt, for good companies. I mean, America is still the place to go, really. Valuations are a bit stretched, but you know, in terms of delivering results, American firms always, well, not always, but tend to outperform European and East Asian counterparts. So I'm sure the PIF will be in the market. I don't have any inside knowledge or real idea about where they might be looking. I think overall, however, they're going to be more focused on the Saudi economy because ultimately that is their brief. Of course, they're a sovereign wealth fund, technically speaking, so you would think they'd be investing money abroad, which they have done, but they are it is the primary vehicle for delivering Vision 2030. And you're not really going to achieve Vision 2030 if you're investing, however, strategically or craftily abroad. It's got to be in kingdom.
I mean, one of the things that the kingdom is investing in internally, of course, and sticking to the energy aspect of things, is renewables, hydrogen projects, etc., clean energy.
Yeah.
The dollars being poured into that, of course, taking up some of that budget as well that's going to the other mega projects. Do you think that there still as much of an appetite for that as the situation with the oil price and OPEC market share gets a little bit more stressful for the kingdom? Is the sentiment that we'll keep up those sort of, I suppose, non-core investments today?
Yeah, you mean in green infrastructure?
Green energy, yeah.
Yeah, sure. I think the green initiative, having been a little bit of an afterthought when it was unveiled, if you like. I think now it has proper traction. I think the Saudis recognize that it has significant job creation potential and obviously diversification potential. And I think the Saudi approach to the green initiative, to the energy transition, is very much on the supply side rather than the demand side. They're not really at the moment interested in trying to coax people to change their consumption behavior. Energy subsidies on most energy is pretty hefty here. But they are interested in carbon capture, which they're actually very good at. They're interested in wind and solar, of course, as well, and green and blue hydrogen. I think they see this as a way of leveraging ironically, a way of leveraging their cheap gas and basically boosting, for example, blue hydrogen and ultimately green hydrogen. It makes a lot of sense. They have a comparative advantage. They're also very well geographically located in terms of providing energy to Europe and Asia. So, for me, there's no either or about it. It's not like a zero-sum game versus oil versus new energy. I think it's all in the mix here, and gas is going to be a really key part of this because it's abundant in Saudi and it's very cheap.
Is there concern on the China economy going forward? This new sort of average growth of 4 to 5% that everyone's saying is the new normal. Does that impact Saudi obviously from a revenue budgetary point of view and its calculations on that front?
Well, it's all in the mix for sure in the Saudi calculations when they think about oil demand. I think it's important to be a little bit more nuanced about China because although growth is clearly slowing, the demand for oil is actually holding up pretty well because the logistics sector in China is really booming. So 10 years ago, it was all about property and big construction projects, which were driving the demand for crude from China. But now it's actually logistics, wholesale retail trade, gasoline. That's where much of the action is, and so that's shifting that moves away from the property and big project stuff, which is kind of dying down in China.
Yeah.
But logistics is booming. So I think, oil demand is probably going to hold up better than people think within China. But of course, the Chinese outlook, it's not great from a structural economic point of view. I mean, they've got a lot of problems, and it's all in part of the thinking for Saudi for sure.
Okay, and then
there is concern.
just to start
there will be
wrapping up.
concern, but I don't think it's keeping them up at night. But when they think long term, there will be concern.
You touched on the oil price in terms of if it got into sort of the low 70s and stayed there, then Saudi obviously would be a little bit concerned from a sort of revenue point of view, and its policy on cuts would change. What has it budgeted for the year ahead with all these projects on board in the non-oil sector as well? What is there a figure out there that it actually will be, do you think, budgeting for as that comes up for planning?
Well, they never publish a figure, as you can imagine. They wouldn't do that. Our estimate is around the $75 a barrel mark for Brent. And actually that translates into about 78 now for Arab Light, which is their main export crude, because Arab Light is very much in vogue in East Asia. So I'm thinking 78 for their budget. We have a figure of around 87 for Brent for the year average, but I'm a little bit, I'm beginning to think we might have gone a bit optimistic there. It will depend a lot upon how much OPEC delivers their cuts from this month on. I mean, frankly, I think traders have given them absolutely zero chance of delivering anything, and I think that's far too bearish or far too kind of cynical. And I think it'll depend. I think there will be upside surprise when those numbers begin to feed through in February and March, that OPEC Plus is actually delivering more than traders gave them credit for. So I suspect there will be some uplift in prices in the first quarter, second quarter. And then, as we move into the second half, as I say, with the Fed cutting, that should certainly lift commodity prices. But yeah, 87 may be a bit on the strong side. I'm thinking maybe 85, 84, something like that for Brent. So as I said, though, the oil price is important, but the budget can still be balanced with these dividends from Aramco, these extra dividends, which are not really related to the oil price itself. So, the idea of a break-even oil price, it's a red herring, really.
Yeah, I mean, okay, and then one more thing then on the Fed, as you mentioned it again, the Fed expectation that, in the second half of the year, we might again see sort of softening in its stance. Is that, do you think, the sort of general outlook? A lot of people are still in disagreement, saying, well, people are getting a bit too confident already that inflation's been brought under control, more or less in the US and Europe, and that the market is again going to call it wrong by sort of predicting what central banks will do on the way down, if you like. How confident are you that we're really in that sort of cycle now of second half of the year, we're in a safe zone for rates?
Well, I'm pretty confident about that. I mean, I'm less confident about the consensus, which seems to be calling for March to begin the cuts. I think that's way too soon, frankly. I think, as you say, the inflation story is still, it's still not been conquered. Services inflation in particular is still quite elevated. Goods prices are coming down for sure, come down a lot, but services is still quite high. Markets are also anticipating 150 basis points of cuts this year. I think that's too much. So what we see is 100 basis points of cuts from mid-year, from around, say, June. I just don't think I think the Fed wants to regain credibility on inflation because it really dropped the ball around it in 2021. So I don't see the Fed beginning to cut in March. This is probably famous last words, but honestly, I don't. And I think we won't see anything happen until the second half. But I'm pretty confident that that the Fed will cut then for sure. I mean, even if it's a soft landing, they're still going to cut. There's no need to keep keep rates high once inflation is under control. And services inflation is coming down. It's higher than the Fed would like at the moment.
And what about inflation in this region in the Gulf?
Well, that's a good question. I mean, we've seen these input prices for projects rising very, very sharply, not least wages. But with Saudi, it's different because, well, not different, but there's a sort of dichotomy between these producer price pressures and what people experience in the shops, because there are a lot of subsidies in place in Saudi for basic food items, which always keeps check on food and gasoline, of course. And B, I think a lot of Saudi firms are reluctant to pass on higher costs to the consumers because it's a really competitive environment at the moment in the non-oil sector. So if you raise prices, you could lose market share quite quickly. So at the moment, I think consumer prices are going to come in around the 2 to possibly 2.5% rate for the year.
James Reeve, Group Chief Economist at Jadwa Investment, thanks so much for joining us today on Halftime Talk. It's been great to get your insight on the Saudi economy.
Thanks, Diana.